Is outside, you can come in, please. It's 2 minutes past 5 by my watch. We should be starting. That's it? Okay. So good evening, and gives me great pleasure to welcome you after, what, 1 year? We met last 1 year back, only one? 1.5 years. Vizag, in Vizag we met. Sorry? I must be legally correct, so Karthik.
Thank you, sir. So thank you for joining us today. Before we begin, a brief compliance note. This interaction is of course covered by SEBI regulation and our code on prevention of insider trading. We will not be discussing any UPSI, so please keep the questions within those boundaries. Request all to keep your questions brief and please do not repeat the questions already asked. With that, it's my pleasure to hand over back to our chairman, Mr. Gupta.
So just to introduce, I don't know if everybody knows Pascal. Pascal has been with us for what, 5 years now? Pascal, 5 years. And he's one of our directors. Looks after what we call the flow control business. He is the worldwide president of flow control, sits in UK. Neeraj has joined us recently. You'll hear a lot from him and about him, from him in the next, hopefully many years to come. Mohinder, of course, needs an introduction. Mohinder Rajput, I'm managing director of the company. All that's good is mine, all that's not good is Mohinder's. So, you misheard. Patrick Andre is the CEO of the Vesuvius group, the big boss of the company. Henry Knowles, General Counsel. I think he must have told Karthik to say this. Did you say this? The advisory. Henry has been a very good friend of ours, very helpful with a lot of things. He's in the board of Vesuvius India, and Mark Collis is the group CFO, and he's also in the board of Vesuvius PLC. So all your questions can be directed to him about finance, he will answer. And Karthik, yesterday I heard that he's known as KK. So Karthik looks after he's the legal director for Vesuvius India. And so we leave this, you want an introduction or that's it? You introduce yourself and start your questions.
Hi, this is Lakshmi Narayanan from Tunga Investments. I have two questions. One is that, what is the value proposition for us for non-integrated steel mills? Because I think when we met in November 2024, you talked about two areas. One is to explore the possibility of getting the right economic in terms of margins and products for that segment, which is non-integrated steel mills or mini mills as you call. And second is some of the other non-steel industries, and I think there's another thing of not only the blast furnace route, but the other route, electric. Is there a possibility of any of our products, being there, right? So I think these are three new markets. You said you were looking at exploring the opportunities when we met in November 2024. So how we have traveled there? And the second question is, in terms of the new product launches, in terms of the innovation, in the last 3 years, the products that or the new SKUs which you have brought into India, what percentage of that revenue is Because that's another metric you said you are tracking as an organization level, where we are in that metric as we speak now. These are my two questions. Thank you.
Yeah, I maybe go bottom up. I answer your last question first. Your last question was around innovation. We derive a significant percentage of our revenue from new products. In fact, that's a very important KPI that is in my personal target. Push the boundary of performance, or new products which give you the same performance but at lower cost. So in all our areas of business, this is a very important KPI that we drive. And this is where the Vesuvius pedigree helps a lot, because we are part of a parent organization that invests, I believe, around 36 million pounds every year in R&D. So we enjoy access to that technology, and we bring that to India.
Can you give one or two examples?
I'm not sure if it would mean a lot, but for example, in iron making, the refractory that is used to line the gully through which molten iron flows.
Blast furnaces.
In blast furnace, this year we are coming up with 3 new recipes, 3 different products that will lead to lower erosion. So, the blast furnace can run longer before the trough needs to be taken down for repair. So that's one example.
This is monolithic.
This is an example in the monolithic. And similarly, there are examples also on what the market calls black refractory, which is the isostatically pressed refractory. There also a lot of innovation, both on the cost side and on the performance side. And also we are on the cutting edge. Vesuvius Group is on the cutting edge of robotic technology as well. So, as you know, all our refractories go into areas which are very prone to, hazards because of the molten steel around. So, Vesuvius robots are considered probably the best, not one of the best, the best in the world. So, even that innovation we have already brought to India. I mean, it's public information. Tata Steel, Kalinganagar, we have our robot running there. So that's on innovation. Your question, there was another question about non-steel business. So we consider that as a major growth area for us. And to give you an example, we recently created a dedicated sales team for aluminum because we see that as a major growth area. And the customer's thinking is also very aligned with Vesuvius thinking. Vesuvius, we believe in pushing the boundary on performance. And aluminum is one sector where the customer wants very high performance products. So we are again leveraging access to global technology from the Vesuvius parent and bringing that technology to India. But I would say we are not very well advanced into that journey. We are midway, maybe not even midway, slightly less than midway in that journey. On the non-integrated steel plants, I think you mentioned mini mills or induction furnaces. Now, mini mills, there are 2 types of non-integrated steel plants. One is the mini mills. The second one is the induction furnace players. On the mini mills, that's already a major business for us. We are already present there, and these players have mini blast furnaces, so our blast furnace products go there.
Meaning arc furnaces.
Yeah.
I can answer it. Arc furnaces versus, he's talking arc furnaces versus blast furnaces.
Yeah, I think I skipped that question. I started talking about the first question. I'll come to the electric arc furnace versus blast furnace one. But on the mini mill side, most of our products are applicable in the mini mills segment also. And it's very good because one of the ways mini mills compete in this market is by focusing on high value added steel. And the nature of high value added steels, what we call alloy steel, they are very quality conscious. They don't want inclusions in the steel, and that's where Vesuvius comes. So mini mills is all we have a dedicated sales team to take care of mini mills. On the induction furnace side, that's a white space for us. We are trying to enter that field, and what we are realizing is there are these large integrated, large induction furnace based players. There are 3 in West Bengal. Million ton or above, and we have products, for example the lining of their induction furnace, we are focusing on that. They need black refractory because they have to ultimately cast that steel, so, we are there, so that's also a focus area for us. The blast furnace and electric arc furnace question I did not get. If you could repeat that question.
So what you're saying is what sort of refractories change would happen if the two steel groups?
So one of the things that will, irrespective of the route, blast furnace or electric arc furnace, the steel still needs to be cast, right? So in both the routes, the caster will still be the heart. And we are very well positioned in that segment. So you will still need a tundish and what we call flux to cast the steel. So irrespective of whether it's an electric arc furnace or blast furnace, we are there. In blast furnace, we supply refractory for the trough. In electric arc furnace, again, we have a very wide portfolio of products that goes into electric arc furnace. So we are very well positioned, to take advantage of that shift towards electric arc furnace. Having said that, if you look at what is happening in the Indian steel industry, unlike Europe, most of the growth that is going to come in the next 5 to 10 years is not in EAF, it's in blast furnace, ultra mega blast furnaces. So we are well positioned in both the areas. Sorry, I think I took a lot of time, but I think I answered all the 4 questions.
Hi, thank you for taking our questions. This is Parin Mehta from Kedara Public Market Fund. I have 2 sets of questions. One is we have always known Vesuvius for its technology, R&D, innovation, and clear focus on flow control, which are high margin refractories. But at least what we hear is in the last 2 or 3 quarters or last 12 months, competition is catching up. And we are hearing that RHI has started entering some of the customers where Vesuvius has been present. If you can give us some context on what is the competitive intensity, is there pricing challenge that's going to happen on the flow control side? So some sense on that. That's one part of the question. And second part of the question is around, we have made investments in new capacities for products like mode flux, etc. So if you can give us some sense on, when do we see the capacities ramping up of mode flux of these new products? When do we expect them to start contributing towards revenue growth, etc.? So some sense. So two parts of the question. One is about competitive intensity, pricing, some sense on pricing due to competition, and the second is new products.
I'll try. So, just as in context and history, the conversion from traditional way of making steel, casting steel, that is the pit casting, to continuous casting happened in India around late 70s. Started from there, a whole of 80s it went into that. So continuous casting, went into that sort of, progress happened from there. In the initial days, India had very little steel that was being made, and also the casters were very few and were very small casters, mainly companies which have closed down like Bihar Alloys or Usha Martin, small casters who were over there. Did we have competition then? Yes, we had. But it was all imported. The companies like DDR in Germany, there was one competition from India. But today what has happened is for the you mentioned flow control refractories. While we started our journey, say 1994, 95, manufacturing in India, we started supplying much earlier from imported sources. The actual Indian competition started happening late 2000s to after 2020, after 2023, with the acquisition of Magnesita with RHI. That sort of shift happened from there. Then there was Kurosaki coming in with Tatas. And then IFGL working with some other companies. So what had happened was a lot of international players wanted to piggyback on Indian companies because they found India to be potentially a big market. So today we have good competition, a lot of international competition, big competitions which are there. But as I always say, we were the first movers. And selling of this sort of refractories, the refractories that you mentioned, flow control, needs a lot of care, service and attention in the steel plants on a 24/7 basis. So there is a service element associated with just manufacturing and supplies. This has not been replicated by any competitor so far. So while we are seeing a lot of big, good players making products, the solutions to the problems of a steel plant are still coming from Vesuvius. And that is why even after 35 years of starting in India, we still command a 55% market share and the three others take the rest. So I think which is still significant in terms of the competition. So this is the first part of it. The second part of it was on mold flux. Pricing, sir, is determined totally by customers nowadays. Customers today are all consolidated. I mean, look at all the big players. They have 5, 6 steel plants within themselves. Take JSW. One man negotiates for at least 4 or 5 steel plants from the same group. Tatas, they have one buying cell in Kolkata and they buy for everybody. So the leverage is so much with them that the competition, the price, everything is determined by the market. There's very little scope, but what we do is the service element and the consistency of quality and the deliveries, what is going around the refractories is what gives us a premium. And in every steel plant we supply, we have a premium for these products that we mentioned. There are Chalu products also where you don't get premium, but it's a choice that you have to make whether you want to supply them or not. But we stick to a better way. That is why Vesuvius has made its mark and Vesuvius stays there. So, as far as the mold flux is concerned, it was there always. In worldwide, there were 2 companies which were the biggest companies, the Metallurgica and Stolberg. And we have bought one of them and have transferred the technology to Vizag from one of them. So the use of mold flux was already there. So all that we have done is we have shifted from an imported source to an Indian source in Vizag. And I exactly cannot tell you the numbers, but I am told that they're fully booked now, completely booked, they're doing well. The plant has stabilized in Vizag and they're doing well. Is there scope for expansion? Yes, there are scope for expansions. But at the moment, the mold flux is a good item, which we put it in. Do you put in flow control or? So we club it with flow control because it is used inside that area where liquid steel transforms into solid steel. Okay.
Maybe to complement what Deep said, on the first point, clearly, our conviction, and it's more than a conviction because we are competing with the same companies not only in India but all over the world, is that we maintain a very solid, if not increasing, technological edge over competitors. This is a very important point. We don't see at all this technological gap closing between us and our competitors for a simple reason, is that we are continuing to invest twice as much in research and development every year that our nearest competitors, and this, because our research and development is rather productive, is producing results. Or it doesn't mean that on this or that specific element you cannot have at some point a competitor having a good product. But if you take on average the range of flow control products that we are proposing, we not only maintain, but I believe that we are slowly but surely increasing our technological edge over competitors. Now, you have another phenomena which can happen in such or such region. It could happen in India, where at some point some competitors have a lot of free capacity. They can make some what I would call desperate actions to gain market share by making big rebates to customers, and sometimes customers can be tempted to say, "Oh, I'm being proposed minus 40%. It doesn't happen every day. These are the Christmas sales. I will take something." I think it's very important for us. We never play that game because we've seen that in the past 30 years. We've seen that 200 times. Generally, when it happens, customers try. We'll realize after a few months that by the end of the day, they buy a cheaper product, but their P&L not only doesn't improve, but may even deteriorate, because the specific of our products, as Deep very rightly mentioned, is that it's not only a good performing product, but it's a product with a service and with reliability. Our product, they don't perform well 98% of the time. They perform well 99.99999% of the time. And this is where the financial difference for the customer lies. Because where the customer loses money is when they have an incident. What creates value for our customers when they use our Vesuvius product as compared with some of our competitors' product is that they have less incidents. So the failure rate of our products is much, much less than the failure rate of our competitors' product. And this is making a huge difference in the P&L of our customers. And at some point, the truth always comes true. That's the reason why, as Deep was reminding, is that at the end of the day, we continue to sell at a higher price than our competitors, and our market share remains above the 50-55%, and this doesn't change. And we don't see that changing in the foreseeable future because our business model remains always the same. We don't compete on price. We don't compete on price with our competitors. We compete on technology. And even in the periods where our competitors have, I would say, a burst of excitement by trying to propose very low prices, we stay cool and we don't play that game. And we play the long-term game with our competitors. This has always been a successful strategy with Vesuvius worldwide, in India also, but not only in India, it's the same worldwide. And we are continuing to do that, and we will continue to do that going forward.
Yeah, hi sir. This is Amber Singhania from Nippon Mutual Fund. Just couple of questions from my side is first, as you rightly mentioned that more than the product, it is important to engage into the services to make the customers more sticky. We have been offering this total refractory management solutions to the customers since quite some time now. Wanted your thought about where are we in that journey? How much of our revenue comes from TRM now? What are our thought process, let's say 3 years down the line, to what size of our total revenue we think can come from services or solutions per se, which is more sticky? That is first. Secondly, we are already around 50-55% market share on our core products as such within the steel. I understand we are expanding towards alumina and other segments for better growth, but within steel, is there further gaps in the product, which probably earlier we were not focusing so much, now we can expand? Like last we added mold flux. Is there any couple of more products which we can add, which can add additional growth for us over a period of time? That is second. And lastly, on a shorter term, as you rightly mentioned that the pricing is more with the customers, not with the company or with the industry as a whole. And we are seeing a lot of cost pressure coming in because of the geopolitical tensions. So a lot of raw material comes from via sea route. There are cost pressures. How do we see mitigating that cost pressures, and when there is limited scope of passing on the prices to the customers? Yeah, thank you.
So your first question was about percentage of revenue coming from service. I don't think we publish that exact percentage, but I can give you an idea. Bulk of our revenue comes from these bundled contracts where we provide the service as well as the product. And I think that's not unique just to Vesuvius. I think Vesuvius, I believe you started this in 2002 or 2003, this refractory as a service concept. And I think the Indian market itself has moved into that area. That's answer to your first question. Your second question was on the steel side itself, what gaps do we see? Yes, we saw some gaps 2 to 3 years ago. For example, in the furnace lining, there are these refractory bricks that are used. And our competitors in India were playing in that area, and we decided to play in that area. And there again, we took advantage of being a part of the Vesuvius group. And we have one of the most efficient brick plants in China. And we've entered that segment. We are today, I'm very happy to say, we are an established player in basic oxygen furnace lining, electric arc furnace lining. So that was a big gap that we have filled in the last, I would say not even 2 years, I would say in the last 1 year. And we have a very good, very healthy order book on that side. And of course, there are other gaps also we see. For example, these super large ladles, 300 tons and above. All these new steel plants which are coming up, they have very, very large ladles. And to control the flow of steel through these very large ladles, you need very high performance slide gate mechanisms and slide gate plates. And there again, we are bringing that know-how and that technology from the Vesuvius group to India. And we ran trials in the last couple of months. Those trials were successful, and we will enter that area. Your third question was around cost pressure. Yes, it's a factor. Raw materials, January 2025 was a crazy period. Aluminas went through the roof. Again, we are in the middle of a crazy period where, because of the war, raw material prices are going up. We have a dedicated team which works very professionally on identifying where are the risks. For example, where are we exposed to a single source? which could use its leverage to extract a better price from us. And we go very systematically identifying who are the alternate suppliers for that particular product. Now it's easier said than done. It's not easy for me to say, okay, this is I buy from Mr. X today, tomorrow I buy from Mr. Y because his product is 5%, 10% cheaper. It's not that easy. We follow a very systematic trial-based process because, as you know, our products are, we deal with lives, people's lives. So it takes us somewhere, depending on the complexity, it could range from 3 months to 9 months for us to trial a new source of raw material and substitute. So that once we do that, we get significant leverage on the pricing. And again, on the cost side, it's great to be a part of the Vesuvius, of the big Vesuvius family, because that gives us buying power. So the major raw materials are bought at a group level by the group purchase team, who is, by the way, side information, also an Indian gentleman who runs the global procurement group. So he and his team have very deep understanding of the raw material market, and they leverage the group's buying power to get us raw material at a price lower than what some of our Indian refractory competitors can buy. So I hope I answered your 3 questions.
One more question, if I may. More on the technological side, definitely Vesuvius has always been on the forefront when it comes to technology. If you can give some color, what are the latest innovation which we might have done, maybe on the robotic side or any other, which bring in a lot of benefits? If you can just give some example of quantification. Like earlier, when we've seen the previous cycle, there was a quantity has got significantly reduced of refractory consumption versus the earlier. Now with robotics, if you can bring in what kind of saving one can give to the customers, maybe in terms of wear cost or anything. Some examples on the technological advancement side, or is the robotics is the one, or there are some more, if you can give some color about the future prospects on that.
Yeah, sure, with pleasure. As Mohinder said at the beginning about new product sales, which are representing typically 20 to 25% of the sales, which are product developed in the last 5 years. And this percentage is not only in India, it's worldwide. Can I give you a few examples? So on the plate, for example, which is the way we regulate the flow of steel from the ladle to the turn dish. We have been developing aggressively over the last 5 years new technology which the concept was known but that was not well implemented, of having a layer of high quality refractories on top of only on top of the plate, which enables to have a longer life and a cheaper plate, because you put the refractory with a lot of value added in minimum quantity, and the rest is cheaper. So we can sell this product at a premium, and it is cheaper. So for the benefit of the customer, that the lifetime is extended, and for us, of course, we sell it normally with a premium, depending on the market conditions, and we save some money. At the same time as we do that, what we introduce at the same time is that we press these plates in mold. In the past, it was a mold, was a plane, and then we had to drill what we call a bore or a hole in the plate, depending on the size at which you want the steel to flow in it. Now we are pressing in a mold where the bore is already there. So we save in terms of scrap. So we reduce our yield, we improve our yield. Yeah? So that example of technology which has been aggressively developed and represents now a majority of our slag and sales worldwide. If we go to the isostatic products, And I mean, I look at it with three segments. There are the products where what is important first is not to have inclusions, the quality of steel. Typically, that's historically for the automotive grades, for example. No? There is a segment where, and that could cover, if you say globally, it's a flat steel plus a big part of engineering long steel, the way we call it. Yeah. There is a segment which was, and that's where Vesuvius has been strong since ever, yeah, for the last 60 years, since continuous casting has been introduced on the market. There is a segment which is more recent, and where we were not present and were actively present, which is more construction steel, which is considered as a commodity, but now you do with very long sequences. That's the technology of continuous casting. So you don't have, after the casting, you don't have a reheater for the semis. You go directly to the rolling mill and the finished product. So very compact mills. Danieli with the MIDA technology for rebar is a leader, for example. And for this technology, you don't need refractories to improve the quality, but you need refractory will last very, very long. Therefore, they're very technical. So for us, it's a new market where we are the leader. We have almost all the MIDA Danieli plant worldwide, which is a new segment. They're developing a segment which is not cannibalizing the rest of it because it's cost rebar, construction were not there. And then there's a third segment, which is more the commodity, classical, long product, where you will see some more competitors. And that's where sometimes maybe you hear somebody, I won a customer. Typically, it's this segment where we go in and out because it's more price-driven, and depending on our capacity, we are less aggressive. So innovation on the MIDA is an example of new product, and innovation on the classical segment. We have developed new mix, what we call the mix, new recipes for the ladle shroud, which we call Duraflex, a new recipe for the 10-inch to the mold, which we call the supplementary nozzle. And innovation is called Durasleeve, where we put zirconia and different mixes, the special part of our tubes, to extend the life. So today we're able to beat competitors in terms of lifetime when competitors want a longer life. And that's critical in some segments. You were discussing earlier about EAF versus traditional blast furnaces. So one of the things we see worldwide is that there are more and more high quality you can do with EAF. EAF initially was done for rebars and progressively improve the quality. Now they go to automotive quality, especially in the US, and Nucor has been the leader in developing high quality with EAF. And so our share with Nucor, which was very low in the past, is increasing, because the more they go to high quality, the more they need also quality refractories. And see with new casters, they really go to a throughput quantity of steel per minute, which was never seen before. So they are very demanding, and that's also new segments which are developing. And this technology are coming to India also. So I think we are going to differentiate ourselves through these angles.
I think Pascal's, what he's trying to say is Vesuvius is quality and innovation. That's the fundamental balance. And there must be many examples that he has, or Nitin, who's not there for the advanced refractories president, they must be working on. So just to reassure everybody that we continue to work only on these pillars of technology and innovation.
Hello. Hi. My name is Sahil Sangvi. I'm a research analyst from Monarch Network Capital. My first question is, I have been looking at this refractory industry since more than 5-6 years. And I think in the last 2-3 years, the Indian refractory industry has seen maybe upwards of 1,700-1,800 crores of capex if I had to add up the unlisted players also. And I've not added the inorganics which have happened. Lot of products have now been added by all players, and there's a lot of collision happening between the products that been sold. I think this was not the state 5-7 years back. We have had capacities being added by Calderis, heavy capacities, Odisha plant, something which has come by Shinagawa, Refratechnic. I think TYK is going to come up with something going ahead. So my question is that, and to give you one more example, magnesia carbon, which was maybe 5-7 years back a heavy imported product, I think we have more than 4-5 players now doing it here and a lot of capacities which have come in. So do you believe that there is an overcapacity in the Indian refractory industry? I understand that India is the only growing steel market here, but is that the case that India is an overcapacity in refractory? And that will somewhere pull down the prices and the margins also for all the players. That's question number one. Second is, with all the new capex that we have done, I think upwards of 300-400 crores, what kind of asset turnover can we expect on that? Would it be safe to say 3 to 4x? Just to understand what room do we have from this 2,000 crores? So that's question number 2. Question number 3 is, while you said that the pricing power is now with the customers more than anything else, are we in a state of negotiation with the customers because they have received good 15-20% price hikes? I'm talking more on steel, but the non-ferrous also has received. So where are we on the front of those negotiations? Can we expect something to happen in the next 3 to 6 months? Has something come in the last 3 to 6 months? That's it. Thank you.
Maybe I can start by answering, and then you may complement Mohinder. There is a lot of talk about overcapacity in India. I must admit, I'm not sure I understand why there is so much talk. You have a market which has doubled in size over the past 10 years, and which will again probably more than double in size over the next 10 years. So nobody should be surprised that suppliers invest in new capacity. It's perfectly normal. If I may, it's a good news. It's not a bad news. It's a good news. Because the only reason why people invest in new capacity is because the market is growing. India is an incredible, favorable market for refractories, and if several companies, ourselves but others, would not invest in new capacity, there would not be enough refractory to supply and to support the growth of the steel industry and other industries, the cement, whatever, in India. So yes, you have new capacity in India, not a big surprise, and not a big topic in some respect, even if I fully respect that it's being talked about, but it's not. It's perfectly normal. The opposite would be abnormal. It would mean that India would need to import all the refractory it needs to support the steel industry. So it's not happening. We are investing. Calderis is investing. Shinagawa is investing. Krosaki is investing. TYK will invest. IFGL has invested. It's normal. The competition, I think it's too. I don't think we should see the competition as a matter of is there excess capacity or not. I may surprise you, but I don't believe that the presence or not presence of excess capacity is the main driver of competition. The main driver of competition is, are others able to do what you are doing? Are you positioning yourself in the commoditized part of the market, or are you positioning yourself in the non-commoditized part of the market where technology can make the difference? And the Vesuvius strategy has always been that. We don't invest capacity across the board. There are some sectors of the refractory market where you will not see us increase capacity. We do not have a strategy or an ambition to be a kind of a generalist, one-stop shop type of refractory producers where you can buy whatever refractory you want, from the most sophisticated one to the most commoditized one. We try as much as we can to stay as far away from the commoditized part of the market. Vesuvius is not a generalist refractory producer and will never be a generalist refractory producer. Because the money in the refractory sector, and you can see the profitability of Vesuvius India, which is not exactly the same level of profitability as other players in India, it has nothing to do with the existence or not of an overcapacity. It has all to do with the technological differentiation of Vesuvius India, which is far above anything else that our competitors can offer on the market. We are very good competitors, but they have, for the vast majority of them, a generalist strategy. We do not have a generalist strategy, and we will never have a generalist strategy. We will focus, we will grow, we will invest in those parts of the refractory market where technology can make a difference, because pricing is in technology. You can price when you can do something that competitors are not able to do, at least not as good as you are. Pricing will never be there in commoditized markets, whether or not there is an overcapacity. So it's very important. It's a nuance, but a very important nuance. So we are not too worried. For us that others invest or don't invest. It's a non-event for Vesuvius. Because for us, what we are really watching is what are the technological progress of our competitors. Because what we want absolutely to maintain, and to get back to a question which was asked earlier during the meeting, what I strongly believe we are maintaining is a technological edge. This is where profitability is.
So there were two other questions you had asked. One was headroom. We don't publish asset utilization percentages, but I can assure you, give you comfort, we have a lot of headroom to grow. I think Deep said we invested ahead of time. We've been very futuristic, contrary to some of our friends who are doing it now. We did it. We saw this coming fag out of the COVID years, 2021, 2022. So we were one of the first people to see that opportunity and invest ahead of time. And we have enough headroom to now ride this growth wave that is coming. Your second question was around price increase. Without a lot of detail, I can just say work is in progress.
And to complement on capacity, not only we have capacity, but we have, and this is also a specific feature, I believe, of Vesuvius as compared with most of our competitors, is that in our two flagship plants, Kolkata and Vizag, both those plants not only have existing capacity, but have room for brownfield expansion for the years to come. So we not only have capacity now as we speak, but we have the capabilities to add new capacity at very marginal and very low incremental capex cost. This is a unique, I believe, unique capability of Vesuvius. And this is true for Vizag, as you know, because we have nearly 2/3 of the land which we have acquired, which remains available for expansion. But this is also true. I had the question from one of you during the small break before the meeting. Also in Kolkata, we have the capability to expand even further on top of what we've already done a few years ago, to expand even further, very significantly, our Viso capacity in Kolkata for a very marginal capital investment as soon as it will be needed. We are already starting to discuss the engineering, but we are 100% certain that it's possible. We are fine-tuning the best way to do it, but we know that we can expand the Kolkata plants significantly above what we are the current capacity. So we are very, very well positioned for at least the 10 years to come.
I was told to hard stop at 6. What time? I mean, I'm okay. I mean, we are all okay.
Please, let's continue a bit.
Yeah, so it's up to you. You all have to catch a flight and go. No, we are all So.
Hi, sir. Just have a couple of questions for you. So, firstly, since there is a lot of steel capex that is, I'm sorry. Since there is a lot of steel capex that is coming online in the next couple of years, I'm just trying to understand if you could call out the opportunity size for specific capex refractories that go out when the plant starts. That's one thing. Secondly, sir, this is another question for Patrick and Mark. The India subsidiaries are, I think, now 90% of your global market cap and 15% of your global EBITDA. I'm curious if that is one of the reasons that is driving the incremental investments in India, and whether you think of it as an export base going forward as well. I think that's my two questions. Thank you.
I will start by answering the second question, and Mohinder, I will hand over to you for the first one. I noticed, I noticed, it has not escaped me, but our analysis is very clear. It's absolutely not because Vesuvius India is overvalued, it's because Vesuvius PLC is undervalued. So we have absolutely no doubt about it. And we don't really look to, when we look at where to invest in the world, we don't really look at the market cap, as you can imagine. We look at the market, and we look at the fundamental of the end market. And the reason why we have been investing over the past few years, and we will continue to invest in the coming years in India, is because we believe that we have a strong conviction in the growth of the Indian end market going forward. That's also one of the reasons for 10 years now, together, more than 10 years with Deep, we have been always very, very careful to maintain a very strong balance sheet in Vesuvius India. Sometimes we've had some questions about that. Why don't you distribute more dividends? I'm sure that you've had questions. The answer is very clear. We want to be ready to invest when we need. We don't need to go to the bank. We don't need to take a loan. We want to maintain a very strong balance sheet in India because we know already that the 10 years to come will be a land of opportunity for Vesuvius India in India. To follow, and our ambition is not only to follow, is to outgrow the natural growth of the market in India. This will require capital investment. We are fully ready for that, and we have been preparing ourselves for more than 10 years for this moment, for this hockey stick in the growth of India. Now we are ready, and we intend to fully take advantage of this in the years to come.
Thank you, Patrick. Just a quick follow-up on that, if I may. See, you've already invested about 700 crores over the last 3 years into capex in India, and I think you'd called out 1,000 crores as the number in the last AGM for Vesuvius Group in India. And you've done some M&A on the other this thing as well, which I don't think is your DNA. I don't think you guys do a lot of M&A historically, right? So I'm just curious if you want to revise that prediction. Is there more capex that you want to announce, or is that something that will follow in some time?
Sorry, could you repeat the question?
You've already invested about 700 crores out of the 1,000 crores that you had guided, and you had guided that over a 4 or 5 year period, I believe. You've invested most of that already. So I'm curious if you want to revise your guidance on that front.
India is a never-ending story, which is so I'm more than happy. It's obvious that more time goes, the higher up our estimate of what we will invest in India. And the good news is we can. the good news is we can. Not only we have the will to do it, but we can, because our strategy in Foseco India, as you may have noticed, if you follow Foseco India, also a very good company, is the same. We've maintained a very, very sound balance sheet. You can recognize, if I may, the Vesuvius touch in both Vesuvius India and Foseco India. In both cases, we believe in the growth of our markets. In both cases, we have been very careful to maintain a very strong balance sheet so that we can finance ourselves our investment each time it is necessary. And yes, we will continue, and probably we will far exceed the numbers which I mentioned some time ago in terms of capex in India for both Foseco India and Vesuvius India.
Question you asked was about exports, I think. Look, if I divide the business into two parts, the flow control part and the advanced refractory part. In the flow control side, the Vesuvius group strategy is to give the best service to the customer. And by service, a big component of that service is availability, when you want it. So if you look at the footprint of flow control worldwide, we have big plants in China, which is a major consumer of that. We have one big plant in India. We have big plants in Europe. We have two big plants in North America. So on the flow control side, I believe the group has optimized, the footprint, manufacturing footprint. Having said that, so I don't see major export opportunities there. Having said that, there are always, these temporary imbalances where somebody needs 500 pieces of this or 200 pieces of that. And I think the group orchestrates that. So those type of small opportunities will come. On the advanced refractory side, the nature of the product is such, very different from the flow control side, that it doesn't travel very well. The reason why I say it doesn't travel very well, it's because it's very bulky. Now, it's a bit like the cement story. If I try to export from here to, by the time it reaches the customer, I would have burnt so much money in transporting it by sea that it won't make much economical sense. And that's why the group has, again, optimized the footprint of plants near the major consumption centers. So, big picture, if I combine the flow control and AR part, Vesuvius Group really believes in local for local. That model has worked very well in the past, and we believe it will work in the future. So, yeah, exports, we will grow, but it's not a major part of our growth story.
53 plants worldwide.
53 plants,
yeah. So Mohan Krishnaswamy, I am an individual shareholder. In Visakhapatnam, we had mentioned that out of 100 of the refractory market, we are servicing about 15 or 14% of the market. Given what Patrick said about no interest in moving into the commodity end of the market, what is the maximum we can reach given our technology focus, and where are we now? Is there more room to grow given what you have done in the last few years? I mean, where maximum we can reach, say 25 or 30% of the market is the limit we will reach? That's my first question. The second is, obviously there is an underlying trend to decarbonize steel manufacturing in various ways. So there are a lot of fuels which have been attempted, like hydrogen and infusion into the blast furnace, or coal gasification. Does any of this have any meaningful impact on the content of refractory from our side? I know flow control is post, but anything else materially changes for us? These are my two questions.
Thank you. We don't comment in too much details about market share, but order of magnitude. The fact, two numbers that have been mentioned today, which says that on a global refractory market in India, we are probably, nobody knows exactly, 13, 14, 15%. But where we play, we are above 50%. So I think it illustrates very well our strategy that we play where we want to play, and there are other parts of the market where we just don't play because we don't see that as a profitable playing field. Now, what is the limit? Where we decide to play, there is no limit. Where we decide to play, there is absolutely no limit. As long as we don't have 100% of the market, I will be on the back of our teams. They know it. It doesn't mean that I believe that they will reach 100%. Huh? But I think that I remember there is another region in the world where some years ago, 10 years ago, when I took over as CEO, we were at 50, 55%. And now we are at 87%. Okay. So there is no limit to the sky. When you have a good technology, when you have good people, when you have the level of ambition, the level of energy, there is no limit to the sky. And this is the mindset of Vesuvius. There is absolutely no reason why we could not increase our market share as close as possible to the maximum, simply by being better than competitors. And this is our ambition. Or will we succeed? We'll see. But I think our job is to try, or we will try very hard, because we believe it's possible. So no, there is really no limit to the maximum market share that we can gain where we decide to play. In terms of decarbonation, there is more talk than action. Much more talk than action. At the end of the day, when you look at what is happening, there is a lot of talk about hydrogen, but hydrogen will be for our grandchildren, if you ask me, because hydrogen is only interesting if it is produced out of green electricity. If you produce hydrogen with an electrolysis, which is itself using coal-fired electricity generated by a coal-fired power plant, forget it. It has a very negative impact on the planet. So really, the use of green hydrogen into the steel industry, personally, I don't believe that this will happen anytime soon. Politicians will continue to talk about it because it gets them elected, but I don't believe at all that it will happen in the foreseeable future. So we don't see that as a major strategic topic. What is happening, however, is in those parts of the world, which is not everywhere, and in particular not in India, in those parts of the world where, because of where they are in their economic development cycle, the generation of scrap becomes more and more significant as compared with the total steel consumption. Typically, the US, Europe, and very soon China. You will see a gradual substitution of blast furnaces by electric furnaces. So for the area, after a certain level of maturity in their development cycle, the electric arc furnaces start substituting slowly but surely blast furnaces. And those electric arc furnaces, then they can use green electricity, they can use gas-based DRI as a feed, known technology, and then the footprint, the CO2 footprint is significantly lower than a blast furnace. This is happening, but not everywhere. In particular, it's not happening in India. There is some talk in India, but the reality is it's not happening at all. And when you see, if you split the India steel production into 3 segments, induction furnace, blast furnaces, and electric furnaces, the one growing the slowest is electric furnaces. So, and there is a reason for that. It's because the generation of scrap is not there. It's just not there. Probably it will be there 30 years or 40 years from now when India will start to decelerate. But for the time being, it's not there, and so it's not a big topic in India. But green hydrogen doesn't really play a role, and I don't see that playing a role in the foreseeable future, more or less anywhere in the world. You will have some kind of pilot plants here or there, which we are very happy to supply because they are good customers, but it's not a massive phenomena. The real phenomena is in the mature area substitution, gradual substitution of blast furnaces by electric furnaces with gas-based DRI. And this, for us, is more or less neutral. It's more or less neutral because the type of refractories that these people will consume for what we are producing, for the field where Vesuvius is playing, are more or less the same than what they are consuming today. So it's neutral, neither positive nor negative.
Hello, Sanjay from iThought PMS Chennai. A bunch of questions, I'll go one by one. First, we had expanded Kolkata VSO plant by 50% in the last few years. So what is the next quantum of capex, or what is the timeline if you can give? And you had also hinted that we'll introduce non-isostatic flow control product lines in Vizag as well. So any comments on these?
Our strategy, our manufacturing strategy is very clear. So Kolkata is becoming progressively and will become very soon isostatic focused plants. And more or less everything which is not isostatic will be produced in Vizag. So it's relatively clear cut. In terms of timing, we are currently reviewing the timing of the expansion in Kolkata, and what I can say with a very strong level of 100% level of certainty is that it will be there before it is needed. Okay. So there will be no shortage of Vesuvius isostatic supply in India because we have the capacity to do it very rapidly. We know exactly what we want to do. The plans are already there. They are in the fine-tuning process. The investment is defined. It is already approved. The only question is when do we push the button? And we push the button depending on our survey of the demand. We'll push the button. Once we push the button, it takes us between 12 and 18 months for this to be on stream. So we have time. We already know that when we have a very good idea of when we will need it, which is sometimes in the next less than 5 years, more than 2 years, and less than 5 years.
Got it.
Depending on where the demand exactly will be. So we are really in the fine-tuning stage, but the investment is already defined. We know that it will not cost us much. Which is, again, I come back on that, one of the huge advantages of Vesuvius is to be able to add brownfield capacity, and significant. I'm not talking about increasing Kolkata by 5 or 10%. It will be a very significant capacity investment in Kolkata, but at very marginal cost and very quick, very easy and quick to implement. This is unique. I don't think anybody has that today in the country.
Got it. And sir, you did talk about Moldflex, but if you can comment on alumina silicate monolithics as well. I think we had set up 120K capacity. Where are we? Do we have to add more capacity? And what is the market size in terms of tonnage for ALSI?
On the ALSI mono side, yeah, 120. I think your number is correct. 120,000 tons. So I will tell you, there is headroom, enough headroom for us for the next couple of years to, extract the maximum juice out of that line. That line was commissioned in
November 24th.
May. I mean, it really started kicking in May, June 2025. We are, and you know, it's a learning experience to make that to make that line dance, and you know, we are on our way to making sure that that line works super efficiently and delivers its maximum performance. So there is enough headroom for the next couple of years to squeeze the maximum juice out of that line.
Final question. I think we had mentioned plastic refractories, if I'm not wrong, in November 2024, the analyst day. And we were supposed to commission it last year. Just wanted to get to the status of plastic refractories and what is the market size, applications.
Yeah, we love plastics. The reason why we love plastics is because it's a premium product, very high value per ton and very good margins as well. And the good news is we brought that to life a couple of months back and we are month on month ramping up. And we have our plans to sell plastics in India, but we are exporting as well. Yeah.
And we are in this Vizag complex, which is initially basic monolithics, alumina silicate monolithics and flux. We are now completing with a plastics plant, which is now operational, a well filler plant. We are doubling our capacity of taphole clay. So it really becomes a very, very significant industrial complex. And to remind everybody, it's only used at 1/3 of the space that we have. So the potential for expansion for the ALSI mono or basic mono plant, I'm eagerly waiting for Mohinder to tell the board, I don't have enough capacity, I need more, because it will be a very, very good news because we have space to expand. And again, at marginal cost. So it's an aircraft carrier. It's a huge aircraft carrier to support the growth of the India market for the years to come. So the sooner we fill the capacity, the better, and Mohinder.
You know, on a lighter note, I'd like to tell you something about Vesuvius. You know, every time I've gone to Patrick and the board asking for more money for CAPEX, I can tell you one thing, it's not given very easily to me. It's in our DNA that we challenge our people a lot, that convince me that you've extracted the last ounce of juice from the machine. And that's where, you know, this lean comes in. You know, we have something called the Vesuvius operating system, in which we look at the utilization of our machines and we challenge our team day in, day night, that before you ask for more money, prove to us with measurable KPI that, you know, this machine can give you no more. And sometimes I have done that, proved that the machine can give you no more. And in that case, the group has given me resources to think out of the box and de-bottleneck. So we are very careful with our money. We invest in CAPEX only when we know we have done our best in de-bottlenecking and there's nothing more we can do with that machine.
Patrick was saying about you have enough space to develop, increase. Just imagine Vizag has a 32 plus 10, 42 acres of land. And as he said, not even 1/3 is used. So we've bought the land. And today, all of you know, if in India, what is the biggest cost and difficulty is getting land and contiguous land without any hassles. So I think we are well off there in Vizag, of course. We have two, I know, you all know that there are two plants there, distinct plants. The precast is one place and the other 5 plants are in another place. So there's a lot of places to rejig, recommission, reposition different plants. So I think even in Kolkata, as Patrick was saying, we have a 5 or 6, 11, about 16 acres of land. Still there's enough space to add up. including the ones where we have the plants, we add up. We do a lot of things like Z-axis utilization and other places. So I think we are well off as far as this is concerned.
Hi. Here. Deepti Rajlapati from Axis Mutual Fund. So you have mentioned a lot about innovation and new technology, and certain products can really get a premium over our competitors as well in the non-commoditized products. So this will help us gain some market share or keep the market share at a stable level. But should we expect some margin expansion from current 16-17% in the next 2 years?
In the PAT?
No, EBITDA margin.
EBITDA is about what, 20%?
17.
Look, we don't give margin guidance, but I can try to answer your question in the most compliant way, otherwise I get in trouble with Neeraj.
You're in trouble with Henry and Karthik.
They're all in cahoots. If you go on our LinkedIn page, you will see two news stories. And we are very proud of that because not many of our competitors put out news stories like that. There are two large steel plants in India. One is Tata Kalinganagar, the other one is JSW's BPSL plant. There, the erstwhile Bhushan power and steel plant. And there, this black refractory that is used, we broke the world record. And the way we measure the world record is that with one piece of refractory, how many hours of casting can you do? And, it's a world record. Now, when we do that, and we continuously attempt to do that, we don't leave money on the table. Huh? And yes, there is a lot of cost pressure, but things like these give us tremendous negotiating power with the customer because it's a win-win. The longer the customer can cast with our product, it's cost saving for the customer as well. And then we have very good salespeople who do their math to calculate how much value we generate for the customer, and we say, give us part of that value. So it gives us pricing power. So we
answer a question?
She's the best judge, but
yeah. Hi sir, good evening. So yeah. So just one question. In the last 3 years, we've spent about 650-700 crores on capex, building on the capacities. So can we expect this run rate to continue for the next 3 years as well?
The run rate of
Capital expenditure in the last 3 years was approximately 650-700 crores. So can we expect this run rate to continue?
I think Patrick answered this just now. I think he says it could even exceed.
Okay.
So he doesn't know, but it could exceed, he says.
Sure.
One point is clear. We don't invest for the sake of investing. I think that Mohinder mentioned that very. We invest to follow the market growth. So we don't say, we want to invest 300 crores or 600 crores. We study the market. We study what we can get from our existing assets. And if we need more, and we invest more. So that's the way, that's the logic that we are following. We are not starting from a number of capex. The number of capex is an outcome of a reasoning, is not the starting point of a reasoning in the way we operate. And so I don't know exactly how much we will invest in the next 3 years. What I know is that in the next 3 years, there will always be the necessary capacity in Vesuvius India to not only follow the growth of the market, but gain market share.
Sure, thank you. And so just one last thing on the plastic refractory. How large is this market in India?
to be honest, I don't have the number off the top of my head. but it's niche. We are not talking of tens of thousands of tons here.
Okay.
If I was to make an educated guess, somewhere between 10,000 to 20,000 tons.
Sure.
So this goes in, for example, reheating furnaces. So in a steel plant, you have these furnaces where they heat the slab before it goes into the hot rolling mill. So that furnace is lined from inside with plastic. Another example is in the power plants, in the boilers. It's lined from the inside with plastics. So those are the two classic applications for plastic refractories.
Hello, this is Kirtan Mehta from Baroda BNP Mutual Fund. I want to understand sort of how much in excess of the market growth that we can deliver. So if at all we look at the India steel market, probably its crude steel production is growing at around 8 to 10% market share, and that remains the large part of the market that we serve. We believe our market share remains more or less stable in the range of 50 to 55%. We are introducing some products where we can probably add more value and grow higher than the market, but at same point of time we are leaving some space where the products turn into commodity, and some of the Chinese and other Indian players might be gaining the market share. So looking at sort of overall dynamics, how much in excess of the market growth that we can deliver?
I will try to answer your question with numbers. So if you look at the last 4 to 5 years, if I look at the CAGR top line, it's been 22%. If you look at the CAGR growth of the steel industry, it's not been 22%. I believe it's been 8% or 9%, something like that. That tells you, when you compare that 8-9% with 22%, it tells you something. It tells you that we are gradually gaining market share. And I can't give very accurate forward guidance, but I can tell you our ambition is to continue that streak of outgrowing the steel industry. And if the plan is to outgrow the steel industry growth, that means that I am gaining market share.
Right.
Did I answer your question?
Does answer, but just to understand in terms of when we also continue to maintain that the market share is 50 to 55%. So which are the areas where we are gaining share and what is contributing to that excess growth?
So I gave one example, the melting and refining business in a steel plant, the brick business, for example, where I went from 0% market share to a double-digit market share. That's one example. On the steel, what else? Flux. We are not new to the flux business in India, but we used to import from outside. Now, our strategy is that we will continue to import from outside, but there is a lot of business which we will now serve from the Indian mold flux area. And there, leaps and bounds, we are growing month on month in the flux business. So that's another, those are two examples where my market share is growing over proportionately.
So it's basically the capture of the white spaces which is probably addressed. So do you see equal opportunities for next 5 years where we have left the white spaces and that can be still captured?
No, there are significant white spaces. Yeah.
One more question.
In last year. So I think the key question for a lot of people in the room is that was last year a one-off, or do you expect the growth to bounce back to at least those 16-17%? So we had 32%, 22, 25%, 22%, 16%, 12%, right? The CAGR is great, but the most recent number was 12%. I think the question is, do we assume a 12-13% growth? Do we assume a 15-16% growth? Was last year a one-off? That's, I think, some guidance on that will be very helpful.
If I may, it's a very good question that is not specific to India. We, on average, outgrow the market, but we don't outgrow the market every year, and we don't outgrow the market the same way. Even the years when we outgrow the market, it's not the same every year. There is no such thing as a typical year in our business. If you want to have something typical, you should look at it over 4, 5 to 6 years. A kind of a sliding 5 years is a better way to look at how we are performing. Because when we win a big contract with a customer, and customers are generally sticky. When they start working with us, it's sticky. When we win a big contract, we have a big jump in market share, and then during 2-3 years, we can grow no more than the market, and then we win another big contract, and then we grow more. So it doesn't. There is no such thing as a representative year. Clearly, we don't grow 10% or 12% above the market. Absolutely not. Absolutely not. We grow on average anywhere between 1 and 3% above the market. If you want to model long term the Vesuvius model, the reasonable but solid assumption is that we outgrow the market on average over a cycle, whatever we call a cycle, by between 1 and 3%. It's not, we outgrow, but it's not 10%. It's not 10%.
Hello. Yeah, this is Rajesh Majumdar from 361 Capital. Sir, if you look at the refractory industry, at one stage it used to be 3 to 4% of steel making costs. But over the last 10 years, it has come down to less than 2% because the specific consumption of refractories is falling in kgs per ton while the value is going up. Where is this trend now? Is there more scope of reduction in this, or do we see some kind of expansion going forward in terms of the steel making costs of the refractory industry?
So you mean that we should increase our prices? I will use you next time we meet our customers. That our prices are not high enough. You are completely right. Specific consumption has declined a lot. Not over the past 10 years, but between 30 years ago and 5 to 10 years ago. We don't see today, there is still progress, if only because our own products are making progress, but the pace at which specific consumption of refractory is improving is absolutely not what it used to be over the past 30 years. So we are not very far from plateauing, in fact, in terms of average refractory consumption per ton of steel for our customers. So the order of magnitude of 2.5%, 3%, depending on where the steel prices are, of the production cost of our customers, I don't think it will change significantly in the years to come. And today, the main parameter is not anymore the specific consumption of our customers, but the value that we create for our customers. It happens sometimes when there are some isostatic products, new isostatic products that we propose to our customers to replace some of their existing generation, which we can sell at double the price. Double the price. Say not 5%, not 10%, double the price. It means that we should never underestimate the room for technological creativity. Doing some R&D really pays off because you can identify new function, new performance level, which can really create some value in the process of your customer. And in that case, the customer, when they are well managed, when purchasing doesn't work alone in a silo on their side, but discuss with the other parts of the organization to really make decisions based on the impact on the P&L, not only on the cost base, So when purchasing is not too narrow-minded, to be clear, then you can really create value simultaneously for Vesuvius and, of course, for the customer.
So according to you, the percentage cost has kind of plateaued, and we can see some increase in that over the next few years. Is that correct? As a percentage of steel making cost, the refractory cost?
I think that not total refractory, because don't forget that in your 2%, you have many things. You have the commoditized part of the refractory, and you have the non-commoditized part of the refractory. So it's the 2% is a kind of average of pears and apples. In our parts, where we play, where there is still a lot of room for technological advances, I believe that yes, we can increase our share of the wallet. I believe it's possible. With good R&D, it's possible. If you talk about basic McCarbon bricks for ladles, no. Most probably no. This is an archetype of commodities. By the way, you will not see us investing into that. Huh? You will never see Vesuvius investing in a manufacturing plant to produce McCarbon bricks for basic commoditized McCarbon bricks for ladles. That's not our business.
And so one last question is that, do you think the capacity expansions in the refractory industry have come way ahead of the expectations from the user industries, and that we'll see a long period before which the refractory industry will come back to have some kind of pricing power vis-a-vis its customers?
No, I don't think so. I don't think so. In the part of the refractory market where we play, I absolutely do not think so. And by the way, we are increasing prices. Because when our costs increase, we are increasing prices. There is no way we would not increase prices. It's out of scope that we would not increase prices when our costs are going up. And this is not 1 year or 2 years or 3 years from now. It's today. It's today.
I think we had a hard stop at 6:30. Now we've passed that time. So with this, we come to the close of this meeting. Thank you all for coming. Hope to see you soon.
Thank you. Thank you very much for your time.